I was thinking the other day, what can be better than putting your money to work and get this passive income? Cupcakes? Yeah, that would be nice. Let's go. Hello everyone, Alex is here. I hope you're doing well. I hope you're staying safe. We're still in this lockdown situation. And I hope you're getting your dividends paid to you every single whatever. Month, year, quarter. It depends. You know the most important thing about money, regular money, like dollar bills and all that, is that they lose value over time by inflation. Thank you, smarty pants. Basically, inflation eats up around 2% on average every single year, and 2% seems like not a lot, but it actually is. For example, in Canada, in the last 20 years, inflation ate up around 47% of our dollar value, which means that $100 in 2000 is the same as $147 today, which also means that the thing you could have bought for $100 20 years ago, you need to spend $147 today. That's pretty crazy, right? And if you look further back, the numbers are even worse. So don't look back. That already happened, right? You cannot fix it. We need to look at today and into the future. So let's do it. The best way to handle and stay on top of the inflation is investing. And on average, stock market grows at around 7 to 8% if you're being safe about it and you're not trying to predict anything, if you're putting your mark into some S&P 500 index or something like that. That's what you're gonna get. And if you deduct 2% of the inflation from that, you'll be getting around 5 to 6% of clean growth. That's pretty amazing. What is also amazing is not only getting this 7% of market appreciation every single year, but also getting paid in dividends every single month. And that's one of the ways how you can establish another passive income source. And a good part about it is that you don't have to have a lot of money to start your investing portfolio. You can start with as little as $1 and then keep contributing, keep improving, keep growing your portfolio over time. And today we're going to be looking how we can use stock market and build our passive income source by investing into monthly dividend stocks. And this is the income you can rely on every single month. Whatever you do with it, it's up to you. Personally, I reinvest all those dividends back to the stocks they're coming from via DRIP, dividend reinvestment plan. I talked about it in one of my previous videos, so you can check it up. But what you need to do, what you're going to be doing with your dividends, it's totally up to you. You can reinvest them back to the stocks, to different stocks, to the stocks they came from. You can use it to pay your rent, to pay for your monthly bills and stuff like that, because this is the income that you can rely on every single month. Let's see what we have here. And the first one for today is going to be Pembina Pipeline Corporation. The ticker symbol is PPL.TO. And Pembina Pipeline is actually a leading midstream and transportation service provider in the whole North America. The company is known for providing safe and cost-effective transportation solutions in the last 6 decades. Their business has grown significantly in the last 65 years through different organic projects and also through strategic acquisitions. The company actually was hit pretty hard during the last year market crash, but also they recovered pretty nicely. Right now the stock trades at around $39 compared to the $53 pre-2020 market crash. They're also trading right now way cheaper than all of their peers. And also since the beginning of this year, the share price appreciated by 27%, which is great. And they're also paying on top of that a pretty generous dividend yield of 6.5%. And we can rely on Pembina Pipeline as a consistent, growing passive income source, as they've been paying dividends since 1997, and also they've been increasing their dividends consistently for the last 10 years. This is great. We're going to be getting a lot of dividends back. We're going to be getting consistent payouts every single month. I expect this company to grow to multiply their value in the next coming years. So I'm definitely into it. I have it in my portfolio for a little while already, and I'm also adding more and more on top of it every single month. Now let's take a look what we have for Pembina Pipeline Corporation from our metrics. The market cap is around $20.9 billion, is growing pretty fast, and I think they're going to multiply their value in the next couple of years. The current dividend yield is at 6.5%, and the 5-year average dividend yield it is 5.5%. So which means that the current dividend yield is actually higher than what is on the 5-year average, which means that the share price of this stock right now is undervalued, which means that it's traded cheaper than it should be, and it's a great buying opportunity. They've also been increasing their dividends consistently for the last 10 years. And yeah, they're part of Dividend Aristocrat list, which is pretty cool. Which means that we can expect dividends being increased going forward as well. The current payout ratio is around 70%, so it's been in that stable, consistent number for a little while, and the company is still coming back from the last year market crash, so we can expect this number to stabilize even more. The 10-year share price appreciation is around 65%, and also right now the share price is traded lower by around 25-30% than it used to be pre-market crash of last year, which means that we can expect a pretty good share price appreciation in the next year or two. Their DRIP amount at $7,200 right now, which is a lot, but if you keep contributing, keep getting their dividends and reinvest them back, eventually you'll get there. The current beta parameter is around 1.75, which means we can expect some share price volatility on the short term, but if you're a long-term investor like I am, you shouldn't worry about that. I think pimping a pipeline has to be part of every single dividend portfolio who expects to get dividends on a monthly basis, or just dividend portfolio. Let's move on to the next one, which is the Northwest Healthcare Real Estate Investment Trust. The ticker symbol is NWH-UN.TO. And this one is actually pretty interesting, and it also attracts a lot of passive income investors because it's the only one stock, the only one real estate investment trust in the cure sector. And Northwest is present in the markets of Canada, Australia, Brazil, Germany, Netherlands, New Zealand, and the United Kingdom. The rental properties are hospitals, clinics, and medical office buildings. Northwest started to expand even more into international markets, and they just acquired 10 huge hospitals in the United Kingdom just last year. Their portfolio occupancy is actually pretty stable at around 97%. What is also important is that 80% of their properties are government supported, which endorses the strength of the revenues and also the dividends payouts. And from Northwest, we are not only looking for dividend yield, which is pretty good, 6.1%, which is paid every single month, but we're also looking for market appreciation because the stock has been growing consistently over the last 5 to 10 years, which is pretty good. We're going to be getting a lot of market appreciation, a lot of dividends back as well. Now let's take a look at our metrics. So the market cap right now is around $2.5 billion. So the company is definitely on the lower side, on the lower end for the market capitalization, but the company has been around only for 10 years, and I think they have a pretty good potential going forward. The current dividend yield is around 6.1%, and the 5-year average dividend yield is actually at 7.2%. And what it means that the company has been gaining a lot into market appreciation over the last year, which is pretty good because we're looking forward, we're looking at the future for this company, we want to make sure they're growing their dividends on top of their market appreciation as well. The current payout ratio for them is actually pretty stable at around 44%. Over the last 5 years, the market share grew by 38%. The company's been having their momentum over the last 5 years, and they're expected to grow even more going forward. Their DRIP also pretty affordable at $2,700, which means that if you invest $2,700 into this stock, you'll be getting enough dividends back from them in order to reinvest back and purchase a single share of this stock. Not confusing at all. The beta parameter for them currently at 0.79, so we're not expecting a lot of share price volatility over the short term, but again, we're long-term investors, so we shouldn't care about that. And let's move on to the final stock for today, which is the most exciting one, and love it a lot. It has a lot of potential, and it's TransAlta Renewables Incorporated, and the ticker symbol is RNW.TO. So TransAlta is a renewable energy company and also the largest wind power generator in Canada. The company owns a highly contracted and diversified portfolio of renewable power generating assets. And furthermore, its solid balance sheet, acquisitions, investment in growth, and stable cash flows suggest that the company remains well positioned to deliver strong financial results in the future years. A pretty good thing about TransAlta's cash flows is that the contracts they are signing with their partners are on average length for 12 years, which is pretty encouraging, right? And we can expect our dividends to be consistent first, and also we can expect them to grow their dividends over the long-term period. Also, renewable energy is something that's going to be growing even more into the future as we're moving more into green energy, into more alternative energy sources as a planet. So it's pretty good to see that TransAlta is positioned very well into that going forward. And now let's take a look at our metrics for TransAlta. The market cap right now is at $5 billion. The current dividend yield is around 5%, and the 5-year average dividend yield is at 6.5%. And now look at it as renewables are getting more popular, are becoming more important in our lives over the last 2 to 5 years. And TransAlta is actually the driver here. They're the largest in Canada right now, and they have a really good potential going forward. That's why I'm very bullish on them. The current payout ratio is actually not very sustainable, is at 270%, and I think this is one of the reasons why they stopped increasing their dividends this year, and that's why they've been kicked out from Dividend Aristocrat list, which is like a bummer, but I think they're gonna come back into it very soon. Over the last 7 years, the share price grew by 89%, again showing that there's a pretty good market appreciation over the long term. The current DRIP amount is at $4,600, and I look at it as a pretty affordable number because you're going to be getting dividends every single month. And the beta parameter at 0.63, so we're not expecting a lot of share price volatility over the short term. So now, overall, if you equally invest into the 3 monthly paid dividend stocks, you're going to be getting a dividend yield of 5.87%. And that is the passive income you can rely on every single month. How cool is that? And these are the companies with a sustainable dividend payout and also very good record of increasing, growing their dividends. And also the company with a high potential into the future with a good perspective becoming even larger companies going forward. Thank you for stopping by here. Thank you for watching. Let me know in the comments if you have any questions. Don't forget to smash that like button, subscribe to my channel, hit the bell, and stay safe out there. Cheers, bye.